In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. And good afternoon again, Market Rebels. It's that time again, 4 p.m. Eastern Time, closing bell. And Stu, what time does that mean?
Coach's Corner.
Coach's Corner, and evidently monthly town hall for us as well. My little alerts are going off the charts here. So Coach's Corner. So thanks for making it here today. Now, last week, if you joined us, and if you didn't, you can go back on YouTube and revisit any of them in the archive. But we talked about surviving the PDT rules, or the pattern day trader rules. So today we thought, let's do a similar one.
Yeah.
So we're going to start off with a little chalk talk question here. So let's say that you bought bought ABC shares at 100. Then you sold them for 80.
Ugh, hate that.
But then, not a good trade. 30 days later, you buy ABC shares back at 70. So they bottom out, or at least that's your perception, and you want to get back in.
Mm-hmm.
Question for you. Is this a wash sale violation? And if you're going, what's a wash sale, then you definitely need to watch.
I got to call my accountant.
So anyway, that's what we're going to talk about is, again, a follow-up from last week, surviving the wash sale rules. Now, quick caveat, and I know that you all know where this is going, especially with the wash sale rules. I can tell you I'm very, very familiar with these things inside and out. I've talked to my tax people. I've looked this up on the web for years. Don't take my word for it, go to the discussion boards and you will see CPAs arguing, yes, it is, no, it's not, maybe it is. Nobody knows for sure. So what we want to do is show you something that can help you to avoid this, but by all means, it's always about consulting your tax advisor.
Yeah.
So
absolutely.
our goal here is really just to show you something to think about, something that most people have never considered, and especially if you've never heard of a wash sale rule. So with that little bit of disclaimer, let's take a look. So the wash sale rule, what is it? Well, it happens when you sell a security and then you buy a substantially identical one within a 30-day window. Now, Stu, I can tell that you already know where the problem lies with this.
Bill, what does that mean? Substantially?
That's where the whole problem lies. You can see it's open for debate.
Yeah.
And I know you and I could get into some heavy debates with the IRS about whether a call option is substantially identical or not. Of course, they're probably not going to want to hear it, so it doesn't really matter. Right.
But again, just something to think about. We're not here to advise you. We're not here to be your tax professionals. We are not registered to be your tax professionals or any of that. This is just some ideas about how to think about another topic, about how you may be able to maneuver through the markets.
Exactly right. So here's the way that it works. If it's 30 days before or after, and so in other words, if you buy back into this, whether it was 30 days before that sale or 30 days after. Now, in almost all of the tax laws, and I'm going to throw in the caveat, almost all, they never count the trade date. So you've probably all heard long-term capital gains is a year plus a day.
1 day.
Why do they make it a year plus a day? Because they're saying don't count the trade date. So that's what they're talking about here. We're not counting the trade date, but you have to go back 30 days prior to it. Don't count the trade date, go 30 days after it. So it's actually a 61-day window where you can get pegged with this wash sale rule. Now, a lot of your brokers will show you on your confirmations and on your account statements and stuff, usually at year end, it'll show things that are wash sales. That's what they're talking about. So, wash sale rule. What we're looking at here is if you do a buy, sell, and a buy, and it was, again, either 30 days before this trade date or 30 days after for 61 days total. So that's kind of a nice visual to just understand what we're talking about. Don't count the trade date of the sale. If you did a buy 30 days before that, or if you do one 30 days after it, that is if you fall into the qualifications of a wash sale, which we're going to get into. But the first thing is to understand this 61-day window.
And this is really important, I think, because I would venture to say that most people kind of think about, well, I have the buy, and if I sell it, and when can I buy, kind of into the future about how to handle that. And what Bill's saying here is think about what you did 30 days ago or somewhere between now and 30 days ago, and what am I doing today? That may very well fall into this, or in fact, it would fall into this discussion as well.
Absolutely. So this is where we're going to find out there are ways to maneuver around it. And that doesn't mean it's illegal. You can look it right up on the IRS's website. All right. It's just you have to understand where the rules are. So let's look at an example. Let's say that, or actually what I wanted to do here, Stu, is to show why they have this kind of a weird rule. Why would the IRS care that you have sold a stock and you bought back into it? Mm-hmm. And you're going, well, I mean, who cares? I should be able to trade in and out of it as much as I want. Well, here's the reason that they did that. Let's say that you have a stock trading at 100, and lo and behold, it does what? Falls down to 80. Uh-oh. Well, here's what you could do. If you say, you know what, I still like this stock, and I still think it's going back up to 100 or even beyond. So you know what I can do? I can kind of pull a fast little trick. What I'm going to do is I'm going to sell the stock at 80, and as second I get this confirmation, I'm going to buy back in at 80. So what did I just do? I just locked in a nice $20 loss that I can offset on some other gains. I'm kind of assuming that most people know that you can take any losses. Actually, what happens, not to get into all the technicalities, you take short-term against short-term, long-term against long-term, and then you net those if you still have a net between them. But you're saying, okay, I've got this $2,000 loss that I can now net against some gains. So if this was the only trade that I had and plus one more of a 2,000 gain, there would be no taxes. Those 2,000 would offset the 2,000 gain. So that's what this person is thinking. And so just that fast, I could do a very quick trade and say, hey, you know what? I got this nice little $2,000 loss, and yet I didn't really change my exposure. And we're going to find out that's one of the it's probably the big criterion for the test to see if you really...
You know what I'm thinking about, Bill? I'm thinking about like a thinly traded stock that a couple of people or a couple of desks could actually kind of push around a little bit.
Yep.
Very temporarily to artificially create this loss.
Sure.
Rolling into the next year. It reminds me of these tax rolls that we used to do on the floor years and years ago. Of course, they became disallowed. You can't do them anymore. But that's, that's kind of what this is all about.
Yep.
Like they don't want you artificially creating this loss.
That is exactly right. That's really the whole heart of the wash sale rules. Now, what we're going to show is really just a simple example, but trust me, look it up. They can get really complicated. Is this substantially different? Is it going through a reorganization to where those are going to be convertible shares in that company, in which case now it might be. I mean, they have hundreds, as you can imagine, gets super complex. Like I said, we're not really trying to get into that aspect for this presentation. We're trying to show you a way to not get into this problem. That's really what it's about. So this is, again, the reason for having the wash sale rule, because you could do this and because your goal is that the stock is just going to go up, but now I've got this $20 capital loss. I mean, how great is that? I didn't really change my exposure, but
how
now
do I do that?
How do I do this?
I want in.
Well, yeah, the IRS caught on to that real quick. So did traders. And so they said, you know what? Enough. No, we're not going to allow this. But now we're going to come up to the real heart of the question, substantially identical. So again, the IRS says it's on a case-by-case basis, and that's really what makes this thing so quirky. Look on their website, they'll just say it's a case-by-case basis. They keep defaulting to this very generic language. They very rarely step up to the plate and say,
no doubt on purpose, right? Just to give everybody an out about who wants to apply what and when and where and how much money it is, and all kind of caveats that go into this.
Exactly. Right. So the real test, again, is about similar exposure. So that's one way to kind of do a little check and balance in your own head and to say, would I feel comfortable arguing, if I had to say that I have kept the same exposure or at least reasonably close? Or did I really make a big change? That's really what they're looking at. So one thing for sure, and they will give you this one since it's a layup on the IRS's site, if you do the same stock, dead giveaway, that's a violation. So if you had purchased Microsoft, sold Microsoft, and buy back into it within that 30-day window after that sale, that absolutely is going to be a violation. Now, what if you do this? It used to be if they were different tickers. They caught on to that one quickly too. So if you had the Fidelity S&P 500 mutual fund and you replace it with the Vanguard S&P 500 fund, that's going to be a violation. Pure and simple. If you overlay those two charts, you're not going to be able to tell them apart. So how could you argue that you've taken different risks or different exposure? The answer is you can't.
I would try.
You try.
Probably
good luck. But yeah, I guess you can always try. Now, here's where things start to get fuzzy. What if you find an index or an ETF, and you find out that the bulk of the shares, again, fuzzy language, what do you mean by the bulk? Probably what drives, again, what do you want to pick? 95% of the fund's performance are the same in another. So even though they might be different tickers, and one might be called the super duper tech fund and the other one is the state-of-the-art hot stock fund, and you're looking and go, they've got exactly the same stocks in them, chances are, and I'm going to put chances are in quotes, that's going to be a violation. That's why I put this question mark here, because even though the bulk of the shares might be there, now we have to say, well, what proportions are they in? Does one fund use leverage? One might be a QQQ, one might be a triple, like the TQQQs, triple levered, which that's clearly not the same exposure. So again, you can see where you start opening up this can of worms where there's a lot of potential debates. Now, one that was interesting, and again, I wouldn't necessarily stake my life on this, but I did find several forums with CPAs, or at least people who claim to be, never know these days with the internet what you're reading, but they were on some chat forums and places where we had to pay for answers, and they were CPAs. And they pretty much all said, if you, let's say, swap your shares of Microsoft with a Microsoft call, no matter what the strike is, that's going to be a violation. Now, years ago, Stu, that was the way out of it. It was very easy. Sell your Microsoft, buy a deep in the money call, different tickers, end of story, no violation. Not anymore. And apparently it's gotten stricter because, again, most of the things that I read said any call option is. Now, what was also interesting, they said that's not necessarily true for puts. Even though we teach people calls are puts are calls, unless you sell a very deep in the money put. So you could sell your shares of Microsoft, sell a super deep in the money put, which would still be basically a delta one, which would basically be the same exposure. But even though with the call options, you could sell your shares, which are delta one, replace it with a, I don't know, delta 20, say, nope, substantially identical. Kind of weird, isn't it?
On that note, it just look, again, I'm going to say I am not a tax professional. I don't purport to be a tax professional. I'm not nearly qualified to say that I could do that. However, it just seems, and this is why you got to talk to somebody that can give you good advice, which may or may not even be correct advice. I don't know.
You could get a different opinion from a different person.
Replacing a stock position with a 20 or 30 delta call, to me, seems ludicrous in the realm of they are similar.
Yeah.
However, that doesn't mean that my opinion means anything.
Right. I think what they're looking at is saying, well, what if you sold 100 shares or bought 100 shares and sold 80? So you're holding on to 20, or sold 100 and bought back 20. And there are rules about if there are disproportionate numbers of shares. They're saying it's still, for whatever shares you're holding, they're still delta one of Microsoft. You've changed the rate of the slope, but you haven't really changed the mathematical connection. So, but again, that shows that there's a lot of debate here. Are we talking about changing the slope, the deltas, or just the fact that it's a one-to-one connection? I don't know. It gets very, very difficult. And the fact that they never give you clear-cut definitions, except in things like this. Now, what's another one? You remember another way they used to teach way back in the day, Stu, that was the easy way out? You sell your shares of Microsoft and you buy it in your IRA.
Yeah, something tells me you're going to say that went away, right?
Went away. And it used to be, people thought, all right, well, if I can't buy it in my IRA, I'll buy it in my spouse's IRA. Gone too. That's gone. So again, they're catching on to a lot of these different ways. And as Stu said, our point isn't to get into the debate about what should or shouldn't be, or it's just to give you an idea of what a wash sale violation is. I also want to emphasize the word violation probably isn't real good. It sounds like it's some type of a black mark in your book and that you're going to get go to jail or something if you're caught. It's not. It just means that you're not going to be able to use that loss, which we'll do an example here in a moment. So just understand that we're not trying to get into the ins and outs here. We're just trying to show you a way to avoid this. All right, so let's march on here. And before we do, time for a little quick public service announcement. For anybody who's new to options, or even if you're not so new, marketrebellion.com/get started for all kinds of great information, articles, videos, all free. Help you to get on a firm footing. Because the more that you're in this business and you start watching things on YouTube, you will see there is a lot of bad information out there. So get yourself on good footing, absolutely free. You can't argue with the price. So wash sale violation. Here's the way that they work. They may disallow losses for the current year. And if that happens, they allow you to do what's called a carry, or to carry over a loss. So it's not like you really lose it. And a lot of people say, oh my gosh, I got hit with a wash sale violation. I had this huge tax loss and it's up in smoke. I'll never be able to use it again. That is not true. You do not lose the loss. You do not lose the loss. You just might not be able to use it in that current year. You would have to use it over. Basically what the IRS is saying, if you triggered a gain, we want our money. We don't want you to artificially create these losses to say that it's a wash. So here's an example. Let's say you buy stock at 100 and then you sell it at 70. Now, it doesn't matter when this is. Could be a year later, could be a day later, but at some point you sell it. Here's where you get dinged with it. You buy it back within 30 days. So remember, if you don't want to get hit with a wash sale, you'd have to be 31 days. We don't count the trade date. So you'd have to let 31 days, 30 full days pass this. But here or maybe we thought we were just making the mark, but we buy back in at 50. Now, another thing, we could have maybe bought in above. Maybe the stock's at 75 and we go, oh, it looks like we're supporting. Let me buy back in. So just because I made this buy less than the sell has nothing to do with it. It's just the fact it's a buy. So if that happens, what's going to go on here, Stu? That $30 loss is not going to be allowed. So how do we not lose this? Well, what you do is you increase your cost basis of the new shares by the loss. So my new cost basis for these new shares is 50, plus the $30 loss, I have a cost basis of 80. So let's say if it goes back up to 100, I would have a $20 capital gain for that year. Now, again, here's what traders were thinking they could do. Well, I bought it at 100 and I sold it at 100, so I have no taxes. See, that's the whole purpose of trying to do this sell buy stuff in between. And so what they're saying is that, nope, you would have a $20 gain. Now, here's why, even in the same year, it's not really disallowed. You just couldn't use this against other gains. But watch this. Let's pretend that the wash sale rule didn't even exist. Follow along with me, Stu. Here, if you got your calculator, we buy stock at 100, we sell it at 70. What have we got so far?
$30 loss.
$30 loss. We buy back in at 50.
Nice.
All right. And the stock goes to 100. So we bought at 50 and sell at 100. What's our gain there?
$50.
$50 combined with this $30 loss is
$20 gain.
And that's exactly what we ended up with.
Right.
So you can see it's not like you really lost it. We just wouldn't be able to use this loss against something else. So maybe when I bought this back here, I never sold it, but I could say, oh, let me use this loss over here against something else. Can't do it. Not going to happen. You could use it for this. You could use it in a subsequent year. All you do is you just tack that onto your cost basis. So again, we're not here to get into all the ins and outs of the wash sale rule. We just want to let you know, because a lot of times we've talked about this briefly or get questions in Q&A. We just want to let people know that it exists. It's also a huge danger of day trading, right? You get in and out. When I worked on the active trader options team, we actually had a guy call up, was in virtual tears, and he was active day trader. And I think he had, kind of making up numbers here, he had something like $600,000 in gains and $700,000 in losses.
And he couldn't use any of the losses.
So you nailed it. So he's thinking, I'm going to have no taxes. And what happened is he had 600,000 in gains, short-term gains, and had zero to offset it. So that's where you can really get hammered. And also now his account went way down, so he couldn't even sell stuff to generate the tax bill.
Yeah. Yeah, there's some tax planning involved there.
Oh yeah, it can really come back to haunt you. So again, we just want to let people know that it exists. If you hear the word wash sale, that's what it is, or you hear wash sale violation, don't let the word violation scare you.
No.
It doesn't mean that you did anything wrong. It just means you're not going to be able to use that loss against something else in that tax year.
Yeah, and keep in mind look, there are ways to have a discussion about this. There's, professional levels, which may carry different levels of what's a wash sale and what's not a wash sale. Maybe there's fees involved. I don't know. There's different things out there. Like if you call yourself a professional, maybe.
Oh yeah, you could, right. You can get
part of this doesn't really apply.
Doesn't apply. Yeah.
But and then another thing is this. There's so many products these days. I know like Nvidia is one, Tesla is another one, AMD is another one. They one of the funds out there, what's it? YieldMax, real YieldMax.
Yeah,
they do things like they're kind of like buy right funds. And I'm just wondering out loud, like if I swapped from Nvidia into Nvidia, I think the symbol is Y, Nvidia and NVDY, would that count? And the answer is I have no idea.
Yeah.
I don't
dicey.
know. I don't even know if your tax guy would have an idea. But it's just something to think about. I don't even, Bill, what do you think about like going from a stock like Caterpillar to a stock like Deere? Would that count?
That's actually a good question. That would not count. They can be in the same sector. And what's interesting, even if their graphs are fairly similar, which I said was kind of a test before that could create a violation, but the IRS makes that very clear. If you sell Pepsi and buy Coke, you're fine because those are two distinct tickers. They're under different management, different dividends. There's all kinds of different things going on, even though you could make an argument and say, you know what, if you look at those charts, they're highly correlated.
And I'll tell you, I couldn't tell the
The
difference if you put one in front of me and which one is which. I
pull up
mean,
Home Depot and Lowe's and all of you'll
yeah,
see that they
yeah,
trade very close to each other.
yeah, they do. They do.
Yep. So that's kind of where we're working with this too about some of the things you can do. Just another little side note. Back when you mentioned about this professional designation you can get to become a
Yeah.
professional trader, but now I haven't looked into it in a long time. I had some friends who did. Um, it had to be your full-time source of income.
Hmm.
So you can't do it on the side.
Hmm.
So that was a big if.
Yeah.
But what was interesting is it was like a corporation. You had to have an annual meeting. You had to have all
Yeah.
these different things.
Oh, yeah.
And
Yeah.
what companies were starting to do, I always find this so interesting how markets spring up for anything.
Yeah.
There were companies that could be out in Hawaii
Yeah.
and for $6,000 a year or whatever, they'll say, okay, we have a meeting room.
Uh-huh.
You have your shareholder meeting, even though nobody
Uh-huh.
shows up. But
Uh-huh.
we put for 1 day or 3 days, whatever the law was, your name and your company on the door. So you can say, yes, I had an office, I had a meeting for the
Yeah.
shareholders or whatever, even though it never happened. Well, the IRS cracked down on that as well, caught on to that.
Yeah.
So all of these little things that people thought were getting around it, sometimes you have to say it's just not worth it. There's easier ways to avoid it, and that's really what we want to show here. So
Yeah.
before we do that, remember marketrebellion.com/get started. All kinds of really cool stuff on there, Stu. Whether you like to read or watch, it's all there absolutely free. Okay, so now that we've covered sort of the basics, and trust me, we're just scratching the surface on this, how do you avoid? Well, it's quite simple. What you can do is just use different broad-based indexes. So for example, SPY and QQQ. So this is what I do. I call it leapfrogging them. Let's say that you sell your SPY and then you buy SPY and you go, okay, I'm back into it, but I also want to, I'm sorry, this is within 30 days. And I say, but if I do this buy, it's gonna be a wash sale violation.
Yeah, that's a problem.
And yet maybe we went off this cliff like during COVID and you're going, man, I just would really love to
Yeah.
buy back in.
Yeah.
Well, what you do is just buy the Qs. And then when you come over here, once that 30-day window has come back in, you could buy back into the SPYs. So that's what I do is I just kind of always leapfrog them. Once that 31-day window has passed, I'll flip over to the other index. And if they're both equal, if they're both over the 31-day mark, take your pick. Maybe the one that I've acquired more shares in, I will then take, or has maybe more dollar value, might be a better way, and just say, well, let's kind of lean that one out, try to keep them balanced. But that's really just how simple it is. So if you like for the anchor of the portfolio, kind of the core, we all know that SPY is the hardest index to beat. So a lot of people have SPY as the core of their portfolio, but if you're buying and selling, especially with all this market volatility, and you get caught into one of these wash sale violations, you're thinking, tax bill's not going to be that big because I've got all of these losses to offset. And then you get an unpleasant surprise at the end of the year and they go, nope, you either have none or not what you thought you had. So this is something you can do is just kind of leapfrog these. Go to your broker's platform, look at your history. I last sold this one over 31 days ago. Fine. You can buy into the SPY or buy into the Qs. But if I sold these 20 days ago and I want to do a buy, just do the Qs. And now in another 11 days, that time's going to be up. So you can always just kind of keep this rolling window. But anyway, it's just something that we have come upon in Q&A, and we just thought it might be interesting for most of you out there to know.
Yeah,
So,
it is really interesting. And and this discussion can really, everyone, really go on forever. I'm just thinking of things
oh
like,
yeah,
suppose you had a position in the diamond, and you wanted to make, you wanted to take advantage of something. Could you move into the XLK, for example, like
right.
would that work? I don't really know what substantially similar means,
I
and
know.
I venture to say that you might not know either, Bill, but who does know? And
Yeah.
I don't know that anybody really knows. It's
And
just,
here's the thing, another little test. If you know a CPA or two CPAs, ask them a specific question, and there's a very good chance you're going to get two different answers. One will say, "Yeah, I can see that argument, but I wouldn't recommend it to a client." And another might say, "Oh yeah, I've done it many times, passes every
yeah,
single time." Yeah,
yeah,
who knows?
yeah, who
Um,
knows?
so if nothing else, a little homework assignment for everyone out there, type up wash sale rules or type up something more specific. Is selling Microsoft and buying a call a wash sale violation, something like that. And look at some of the discussion boards
Yeah, it's really
and look at
cool.
all the people that are professional. They'll sign it professional tax advisor, CPA, and you'll see absolutely diametrically opposed answers.
Yeah.
So
Hmm.
don't be surprised if you see that. But anyway, we thought this, if nothing else, should at least open your eyes to what a wash sale violation is. The fact that you don't really lose it, you just might lose it for that current year. And also some ways to think about how to avoid it. So with that, Stu, let's bring up Chalk Talk. Let's see if people figured this out. You bought shares at 100 ABC, you sold at 80, 30 days later, you buy them back at 70. Is that a wash sale violation? Absolutely. Same underlying within 30 days, bang, wash sale violation. So again, this might be a time you can say, could I stretch it out another day or a couple of days here? Let's get that 31-day window.
Or if you bought XYZ, is that a wash sale violation?
No, right, exactly, right. You can swap them
Maybe,
for,
maybe
well,
not.
if they're different tickers, again, they can be in the same sector. The IRS does make that very clear. So again, if you sell Pepsi and buy Coca-Cola, you're fine. You're
Hmm.
absolutely fine. You can sell Lowe's and buy Home Depot. You're fine. But again, I could make an argument for saying if that's okay, why is it not okay to sell your shares and buy a 20 Delta call?
Or why is it not okay to do the Schwab S&P versus the Fidelity
They're
S&P?
they're different tickers, right? I mean,
Different tickers. See, it gets messy. And
it does get
that's
very messy.
that's what like I said XLK versus the Dow. Suppose it's XLK versus the QQQ.
Yeah, yeah,
it's a discussion that you have to think about having. That's
yeah.
all we're trying to say here.
So what's another way to absolutely unequivocally avoid this? Just don't do these trades in and out of stuff. Give yourself some time. We always talk about scaling in and Q&A or scaling out.
Uh-huh.
So, I mean, really, how much is a market going to move in 3 or 4 days, or really within, and I know it can, but typically in 30 days, you don't get a ton of movement. So if you're trying to scale in, give
Yeah.
yourself 60 days or 90 days to do this, and you'll never have a problem, even if it's the same underlying. It's just when you're doing the fast in and out stuff that you're going to run into trouble.
And here's a thought. Having to pay some tax rate on money that you made, that's not a bad problem to have.
It's
It's,
not, but when you could have had losses, especially by waiting one more day, um, or you thought that you had them, so in your head you're thinking, oh yeah, tax bill is going to be zero, and
yeah.
then they're not. It does count.
Yeah, sure it does.
Yep. So to be clear, is this a wash sale violation? Absolutely.
Yeah.
Yep. So anyway, good stuff. I hope that helped. Again, we were just had some people bringing that up in our Q&A classes. If you're not part of the Rebel Nation, as Mark likes to call it, which I think is a great term, by the way, please join us. You can join Stu and me for Q&A twice a week. These are some of the many conversations that we get into and on deeper levels, but mostly on options, strategies, and how to help you become better traders. And so you can contact us at marketrebellion.com, speak to one of the salespeople. We'd love to have you in Q&A. And with that, Stu, I think that's all that we have. Any closing comments?
Maybe we just take a minute. I'll take a minute to mention we are having a pretty sweet conference next week down in
We
Miami.
are.
Wiz Clayman's going to be there, a couple of big
Yes.
names.
Some big names.
So maybe come join us. It's going to be a fun time, and
Especially if you're local, why not? Just drive on over and
it always helps to kind of rub elbows with people that have similar interests. You never know what you're going to learn. Right?
never hurts. And I'm always amazed at the level of people that show up at these things.
Yeah.
Just absolutely crazy. So if you haven't signed up, please do so. Check us out. Again, you can check us at marketrebellion.com. Speak to one of the salespeople about tickets. I'm not even sure if they're available. I think we might have a few left, but check it out, especially if you're down in Miami, actually Aventura area.
Yeah.
Just drive on over. We'd love to see you. And with that, we hope you picked up some new information. That's mostly what this is always about. Just pick up something new each day, and you're on your way to becoming a better options trader. And with that, thanks so much for joining us, Stu. We got to get Scotty on next week.
Yeah.
He hasn't been on in a while. And thanks to all of you out there in YouTube, and we will see you next Thursday on Coach's Corner.